Okay, let's get started. This is Satya Pradhuman, the Director of Research here at Cirrus. We've just put out an alert, effectively a cautionary note. The title of that report from the Signals report was Speculation Models Issue a Buyer Beware Stance for U.S. Equities. Now, in the actual report, there are a few things that just changed in a pretty dramatic fashion. Number one, our speculative reading on the US, that's the Cirrus risk appetite, that model has jumped to well above normal, effectively cautioning investors to basically lower their beta. In addition to that, for the last few months, we've also had a fairly crowded US equity market. Both of these signals, the last time we saw both of them trigger around the same time was back in August of 2020. I'll go through some of those results. They were fairly alarming. In fact, addition to this, our asset allocation model has just gone slightly underweight equities. This is the first time in about 3 years. I'll walk you through some of the implications there. But the bottom line, though, is that what this cautionary note is about is a broadening of markets. It's a rotational market that I think we're going into. In fact, our style indicator is now in a lean value mode. It's been there the last several months, but at the heart of this underscores this risk to trending factors that currently run hard. Now, it's very tough to deliver a cautionary note in this environment. In fact, if you look at the credit cycle, whether it's the US or Europe, most of the credit markets and credit spreads are now historically low. The US, in fact, those spreads to treasuries currently are below like a 300 basis point number. This is like 30-year low. So, what is there anything really to worry about here? The labor market, it's been softening a bit, but honestly, it looks fairly good when you're just coming off effectively 50-year low unemployment rates. And in fact, looking back in the last earnings period, we saw a fairly upbeat to decent earnings backdrop, even in the thick of this sort of back and forth on tariffs and the uncertainty that still remains there. In fact, year to date, the S&P is up a solid 13%. These are great numbers for a full year. And in fact, from the April bottom, though, this is what's shocking to me. The market's up about an additional 30 some odd, 33%, at least as of today. More importantly, if we look to the sort of technology sort of dominant piece of the market, large mega cap techs, using, let's say, the Qs as an example, that ETF is up about 16% year to date, but importantly, it is up about 42% from the April bottom. And the Russell, which has been a laggard, it's up only 7% year to date, but it's up 37% since the April bottom, outperforming the S&P 500. So with all of this in mind, this buoyant backdrop that we find ourselves in, it's especially notable as we're going into a slowdown. And in fact, on top of all of this news, we're expecting the Fed to cut rates, and possibly not just once for 2025. In fact, if you go to the betting markets, the consensus right now is looking potentially for 3 rate cuts. That percentage, that likelihood back in August was just 10%. Today, it's moving up to about a 50%, a 1 in 2 chance of getting 3 rate cuts, not just one 25 basis point cut. So this message about speculation running too hot, becoming more defensive, this does fly in the face of where we're really comfortable. In a time where the trend is your friend and fundamentals valuations have not mattered, if anything, they've really, really worked against you, this is a very, very tough pill to swallow. The active managed results have been really, really tough this year. In just the last 3-4 months, especially with this run up, you're looking at 10-15% gaps in performance when we look at our active blends, whether it's quality growth or GARP, and even the aggressive growth blend, they have not behaved as well. Moral of the story is that these numbers reflect the real angst that most active managers feel. The pain's been notably direct in large growth, that sort of box of performance. Smaller value, the small cap numbers are not as great, but the relatives on the value side has been much more cohesive and constructive. But at the heart of this, though, this is a very tough message to send out that we want to now look at these tactical measures as a driver for changing the posture, not chasing the tape. Let me do my best here to walk you through some of the details, and we'll try to come through how we're framing this environment and also how we put this to work in the portfolio. All right, let's get started. The CRX, that's our proxy for the Cirrus risk score. This variable measures basically several factors representing risk taking. So for instance, things like if low price stocks are outperforming high price stocks, that's a point for risk. If no earnings companies are beating earnings based companies, that's another point. If high beta is outperforming low beta, and so on. So you get the gist of it. There's 7 variables. We look at that over time. We smooth that on a 6-month basis. This number has jumped well over what we consider to be meaningful, a 1 standard deviation reading. The back tests we have run have basically shown this measure to be a fairly decent contrast signal. In other words, it's really when we're scared out of our wits and these readings go well below a minus standard 1 deviation that we tend to see the highest expected return zone in the marketplace. Conversely, when this model starts to strike well above normal, look out below. At the heart of this, a few things change. Expected returns for markets tend to get weaker, but more importantly, if we look within drivers of return, what we find to be more meaningful are trending factors tend to reverse sharply. Valuation factors seem to come to life. Investors begin to pay up for earnings visibility for quality. So this is a different kind of market that we've suddenly moved into. In the last 5 or 6 months, we've seen, we've heard calls for, hey, the market's crowded, even our model that went crowded. But this model was quietly building steam for about 5, 6 straight months. The risk appetite has climbed to this unusual territory. A little close-up of this. In fact, the last time this model triggered a sell reading was back in August of 2020, as we all recall that window, where really the at-home stocks, the Pelotons of the world, were running to new highs. And somewhere August, September, we started to see a change. In that window, as investors had bid up the most speculative pieces as the Fed really unleashed effectively free money to the system. Once this model triggered there, over the next 12 months, what we witnessed was that the price momentum models in large cap inverted by 18.6% 6 months later. So within 6 months, trending factors reversed sharply against the weakest trading stocks, and about 21% 12 months later. So this is meaningful stuff, but it's not alone. And I think that's why we're raising this sort of alarm. In fact, if we look now to the crowding model, we are now at levels above what this measure was as it spiked in October 2007 to well above normal. In fact, we're higher than that October 7th reading. A closer look at this, though, would suggest that, hey, the last time we just broke through this territory was back in January. That number, that period coincided with as we went right into the tariff wars, and we got a massive pullback. This reading normalized and then spiked back higher. So what is in our crowding model? This is, I find, one of the most overused words in the market the last few years. I think the traditional measures are flawed. The traditional measures of saying, hey, did you know 7 stocks outperformed everything else in the market? In fact, if you subtract those 7 stocks, the market was I'm going to make this number up, the market was down or was only up 2%. Okay, so that's a proxy. The problem with that logic, though, is this, that you're looking at leadership stocks. If you take the AI vertical, for instance, which is really dominating this current sort of narrowed leadership, when you look at those firms, the fact that if they're earning their way into their market cap, Who cares if the market's narrow? So what's special about this model is that what we're saying is that this is a valuation model that have leadership stocks earn their way into their market caps as they raise to new highs. And so we are now, in the last few months, back to an excessive level. And again, similar to our risk appetite reading, in periods where these readings go in excess, that's really where you see subsequent reversals in leadership and valuations and quality start to matter. You might want to say that value and quality outperform. Maybe a better way to say it is, hey, they lose less ground if the market pulls back. And this is really timely because it's only 5, 6 months ago this model had triggered a sell and leadership broke down. And we're still in an AI world, right? And yet you could see very, very high risk, high trending stocks reverse sharply overnight. And I think that's what's very sobering about this moment, that we could still love this theme, but if the ground under us begins to change, if we're all sort of chasing the same thing, at some extreme, that's really where we want to think about how we're positioned. And so we bring both of these measures into what we call sort of like a risk clock or a pinwheel in some parlance. And we layer upon this cycle a sense of highs and lows. So at the very bottom end, I would consider this to be a really pessimistic reading where there's really no leadership and quietly we're starting to define leadership. Momentum factors are not truly working. At the upper end is extreme optimism, where momentum high beta led our way to the sort of midnight world. The CRX now strikes that sort of like midnight moment. And on top of that, the crowding model is coinciding into this upper range as well. In this window, what we've seen is momentum factors break down, value factors, quality factors start to outperform. In fact, to put this two together, the last time this really occurred, we did see that in August 2020, that the subsequent 12 months large price momentum model was down about 21% versus their peers, the weak trending factors. In small caps, it was also fairly sharp, but not as dramatic. Leadership stocks underperformed in smaller caps by 8% against let's say, the broken stocks. Larger value, that was up about 4% outperforming, and smaller value was up about 19% outperforming the more expensive counterparts. So empirically, we do have a world where when these two elements coincide, it is a period where we want to take these signals much more seriously. What has changed as well, and this is what was published in the signals report, is that what was also occurring quietly in these last few months as the markets raced to new highs was that the equity allocation model we've been running, and this model the last 5 years or so has been run out of sample, and it's been fairly compelling with the pandemic window as the Fed began to really cut rates. This equity allocation model went above 90%. As we were going into the tightening cycle, the model really corrected to like effectively a full fixed income view. In fact, the last time this model went below the longer term average, so the long term average for this equity allocation over the 30-year window is about 49%. So this model's quietly stretched back and it's now below that number at a 47% level. In fact, the last time this occurred was January of 22. And in that window, what we saw was that the overall market was down about 12%, about 12 months later. So this reading is, it's fairly compelling. And when I bring this together, you form a mosaic that is telling us that the market is very frothy, and we want to play some defense. In terms of fundamentals, though, what's underneath some of this and what makes us uncomfortable is this. What we're expecting is the Fed to begin cutting rates. And one thing, I've made this observation before, that I really haven't seen this in the 30 or so years we've been doing this, of where you've got a steepening yield curve, a term structure that's backed up, as the central banks begin to cut rates. So a bunch of things are loaded in there. So for instance, the ongoing concerns about the fiscal path of the US debt. There is significant concerns on inflation, especially as we're still in this sort of tariff morass. I don't think we're really out of the woods there yet. And also this sense of really a hyper focus on reshoring. All of those things tend to be a bit more inflationary, and it might explain the moment, and might also explain the moment why the Fed struggles with cutting rates at this moment. So bottom line, though, that not everything is right, and it doesn't feel like it's business as usual. In fact, when we look at the world of valuations, this is something that's not been a great stock selection factor, right? We get that. However, we're now looking at historic gaps within the US, large mega caps, and the rest of the marketplace. And importantly, we're also seeing a historic gap that's opened the last 20 years between the US and the rest of the planet in terms of leading equity markets. Year to date, though, this is starting to reverse. And so what we've seen are some of the international markets really begin to outperform the US. And recently, we've also begun to see a broadening even in the US. In fact, in August, we saw a 7% move in the Russell 2000. In addition to that, gold climbed higher. And so those are the things that are telling us that maybe it's not business as usual as these readings get to new extremes. This broadening that I described, even this year in AI, we're also seeing a broader thesis. In other words, what we've built in the last year are these upstream and downstream baskets that represent AI. And what we can now show is that you're now looking at other areas such as data centers, alternate energy, cybersecurity. They're now outperforming the sort of upstream plays, effectively the AI chip bins. So moral of the story is that we do have a broadening that's going on here. So you've got a softer outlook. The market has run sharply over 30% or so since the April bottom. And now, if there's a slowdown that's going on, how could markets go to new highs if we're concerned about a slowdown? Well, it's possible that in this instance, we really did buy on the rumor, right? The fact that the market's slowing down, we don't have a real clarity on tariffs, and yet markets run up another 30 some odd percent. And in fact, the Russell runs up 37% from that April bottom. So what gives? At the end of the day, the market has done a great job pricing in interest rate cuts. The question is, how severe? And so when we look at the earnings backdrop, this is what really is wacky, and we're going to be doing quite a bit more work in the earnings front. What is odd to us, this reading for earnings revisions data, when you look at the smaller cap market, it has suddenly galloped up to like 60% positive territory, meaning 6 out of every 10 estimates are getting raised. Okay, that's very different from sort of going into a slowdown window where maybe that number should be more in the 20 handle. More dramatically, though, and maybe what's more concerning, is taking a look at the larger cap comparisons. What we're seeing is over 70% of estimates that are getting raised higher. So as we're here looking at a slowdown, still quite a bit of an uncertainty and concerns on inflation with a yield curve that's fairly steep. On top of all of this, we have analysts that are raising estimates to new highs. Now, we're not done studying these numbers, but just initial glance at the subsector work is showing that it's fairly broad-based. So in other words, the market has already jumped the gun. I guess what this leads to is now a fundamental linkage, which is as we're going into the earnings season in a few short weeks, we're looking at a world where you've got a slowdown that's occurring, you've got some Fed support, and yet you already have the sell side estimates poised for fairly strong growth. So that is a real sort of juxtaposition that you should be uncomfortable with, especially when some of these basic tactical measures that are tested are now flashing and moving together in some extremes. So at the end of the day, I think this is something that really is um, worth taking a look at and pausing. Now, in terms of what we do with this house view, I get the joke. It's, in active performance terms, if only 6 or 7 stocks are leading the market, and in this case, maybe it's a little bit more now when you have the likes of Palantir's on that list. But at the end of the day, how do we put this to work? And in terms of the blends that we're running, what we're forced to consider here is that if, for instance, the better performing of our growth models are in the aggressive growth area, meaning the trend is my friend, and I've got these models that are firing red, I am forced to now move towards either a more valuation friendly backdrop or at least a higher earnings visibility backdrop. I've got to play defense because it does look as if the market's done a great job forecasting the Fed. And so if I'm on the value side, clearly I'm going to avoid the deep value blends and I'm going to move into the quality value areas. Specifically, though, when we look at the portfolios here, what could be at risk? I do think we've seen a massive benefit to the AI themes that are abound and all the sort of downstream players from uh, data centers to cybersecurity. But in addition to that, we've done a good job in the last year or so flagging that the industrial segment is also a piece of this AI puzzle. We've argued that there's sort of the plumbing to the system somewhere between data center and power generation. The industrials have also moved. So if you're a value investor and you're saying, hey, this is maybe I get my day, I would say be careful because a lot of folks have really started to chase this theme in any way they can. So really quick takeaways here. Speculative run up in the US risk appetite model is flashing red. We've got a crowding model that's gone further. Our asset allocation model has been fading and now below the long-term average. It's not in a 20 handle, but it's in the 40s, which is still below the 49% sort of business as usual equity allocation. And this idea about rotational market, the value growth rotation signal is saying, hey, become more valuation sensitive in this environment. Those are the things that, seem to make sense. So from a game theory standpoint, what's your downside risk here if you decide to fade uh, and go counter to sort of the trending and leadership? The bottom line is if we're wrong, you lose ground. Your relative performance gets worse. Markets rise faster. Um, you're going to make money, but you're probably going to lose relative to your benchmark. But what happens if we're correct and this reversal becomes more expensive if you lag on the way up, right? So if you're lagging on the way up because only a handful of stocks are working, and then you chase this and then you lag on the way down, that is a very, very difficult sort of setting. So the current backdrop gets pretty tricky. Most investors agree that there is a sense that we have a shaky labor market and there's a risk of softer consumer spending in the works. That said, we can look through this as the Fed lowers short rates. And so maybe we're okay. So where we're at now is this market has to run to new highs, can run to new highs, expecting the support of the Fed. In other words, it seems that the economic backdrop needs to be just soft enough to justify rate cuts, and yet not too weak where corporate profits break down sharply and we get a massive deluge of earnings misses, right? So at the heart of this is a Goldilocks slowdown is what we're betting on that's needed to appease this market run. So in this environment with so many moving parts, it does seem to me that hope has become a new strategy. And this is something we caution on.